How do you interpret what you are hearing for corporate America when you need to give advice to clients?
Look, Sarah, it's a great question. And so we're looking out over multiple years as equity investors, but absolutely next year still is critical. And what we've seen at the moment is just some tempering of that inflationary picture, which gives people some confidence that on the inflation print, on the terminal rates for fixed income markets, you can start to find some level that you can price equity markets. Now, I would say, evidently, the rally we've seen in the last few weeks does bed in a lot of positive optimism. And so we're seeing a little bit of a rollover of that as people start to get a little bit more concerned about the probability of soft landing. Maybe it's not 50-50, maybe it's a little bit weaker than that. But when we're looking at opportunities across the equity landscape, we still think that's more likely than not likely.
Your boss, David Solomon, just says 35% chance, he said today, of a soft landing, which doesn't sound like high odds.
I have to be very careful how I frame it, but when we're looking at it, we still think that inflation print 3 weeks ago gives us some degree of optimism that inflation is coming down. It's been very much in the good side of things, supply chains reopening, seeing some normalization of those one-time issues around, say, second-hand auto sales. We still see tightness in the labor market for sure. And to the point that was made earlier, we haven't seen that attrition in the consumer. That is where the risk is. If you see that delayed mechanism of monetary policy starting to hit household budgets, that could have an impact on retail sentiment, on consumer. But at this point, we're still optimistic, and we see corporate CEO guidance across a variety of other sectors still being quite favorable going into next year.
So, decent entry point for stocks? Technology even?
Cautious just in the short term, because we have seen a rally in the last couple of weeks, but actually as a longer term investor, some of the technology space looks very attractively valued to us.
Which parts?
Take software as a good case in point. Think of that as a deflationary investment. If you're a large corporate at this point, you're not stepping back from your productivity software investment, whether it's in manufacturing or automation technologies, in white collar industries where you're thinking about a work from home hybrid model. How do you use productivity technologies to improve the per unit of capital output, per unit of labor output from that investment? And so we're not seeing from
Well, it depends how long term you are, because everything you just said may be true, but it's also a sector that suffers when IT spending budgets get hit during recessions.
That's absolutely right. I would say on that front, the two areas that we're not seeing people step back from that software and technology investment is productivity-based software solutions and cybersecurity. And we can understand why. I think it's hard for a corporate CEO at this point in time to say we're going to roll back our CapEx agenda as it relates to cyber, given the challenges we see globally. And so selectively, and I think the headline here is that, yes, equity markets have a little bit of a challenge going into next year off what is a slightly higher multiple on the last couple of weeks, that rally. But selectively, if we can take a view of where there's opportunity for fundamental strength next year and long-term growth aligned to some of those secular megatrends, that's a really interesting place to be.
Software, I think biotech is also on your list. Is that right?
It is. Selectively, again, very thoughtful around what type of biotech exposure you want to take. But we're talking about a complete dislocation in the valuation side of things for some very high-quality biotech, genomics-aligned businesses that are going to find solutions to some critical health issues, and actually at this point are not being reflected in valuation. I'd say as much as we have an IPO market that's fairly shuttered as it relates to technology, an M&A that's been a little bit more muted, we think going into next year, M&A activity in the biotech space, as Big Pharma uses that built-up cash on balance sheet to just rebuild their pipeline, is a really interesting place to be.
Yeah, there were some hopes that biotech M&A was back this year, and it's sort of been sidelined. You also have Chinese consumer companies on your list, which, isn't that risky to invest in China now, not having any clarity on zero COVID, the regulatory environment, the geopolitical environment?
Again, I think we have to be very thoughtful around selectively allocating capital into markets like China as well as broadly across emerging markets. Actually, that heterogeneity and the fact that you have greater separation in outcome is quite interesting as an active investor. On China specifically, we think the prospects of reopening with a successful, hopefully, mRNA vaccine rollout through into the early part of next year, potentially a slight alleviation of that zero COVID policy into the second quarter.
You're just betting they're going to use a Western vaccine?
I think there's going to be a higher probability of that, or at least what you're seeing coming out of Chinese biotech space is greater efficacy in some of the domestic solutions. And if you can roll back some of the zero COVID policies and actually reopen the domestic economy, not only is that a good demand impulse globally, it's also a good supply impulse in the sense that you reopen supply chains. So some of those high quality technology and consumer facing companies in China selectively actually look very cheap.
Interesting ideas. Thanks for coming on and sharing them with us. Luke Barrs from Goldman Sachs Asset Management.